Hi, my name is Judith Ranieri, and I am the co-portfolio manager of the Gabelli U.S. Treasury Money Market Fund. Today, we're breaking down the key takeaways from the Federal Reserve's March 19th meeting, one that truly carried added significance as the committee navigated fresh uncertainties weighing on the economic outlook. Now, chief among these concerns were obviously the unpredictable impact of the newly imposed tariffs and how they might ripple through the economy, potentially reigniting inflation. So with these risks in mind, the Fed unanimously voted to keep the federal funds rate steady at 4.25% to 4.5%. But the tone clearly shifted towards managing the heightened challenges tied to those trade policies and their potential impact on growth and price stability. Now, in its updated statement, summary of economic projections, the Fed lowered its 2025 GDP growth forecast to 1.7 from 2.1. They raised the PCE inflation to 2.7 from 2.5 and nudged the unemployment rate to 4.4 from 4.3, obviously signaling growing caution. Now, despite keeping rates unchanged, the Fed maintained its forecast for 2 quarter-point cuts later this year. Yet, Powell did emphasize that future moves will all be data-driven. A key policy adjustment at this meeting was at the Fed's decision to slow quantitative tightening. Now, beginning April 1st, it will reduce the cap on monthly Treasury runoff from $25 billion per month down to $5 billion, while keeping the mortgage-backed securities cap at $35 billion. This move is intended to basically maintain liquidity and prevent financial conditions from tightening unnecessarily. Now, further complicating liquidity conditions is the ongoing debt ceiling matter. As the Treasury awaits resolution with that decision, it has been drawing down its general account to meet its obligations, temporarily injecting liquidity into the system. Now, once the ceiling is raised, the Treasury will then begin to rebuild that general account and therefore withdraw liquidity out of the system, making it very difficult and harder for the Fed to assess true liquidity levels. So by slowing down QT, the Fed gains flexibility to manage these uncertainties, avoid draining reserves quickly, and maintain stability in the money markets. So in summary, this meeting highlighted the Fed's measured, flexible approach, balancing inflation risks, trade policy uncertainties, and liquidity management, all while remaining guided by incoming data. Thank you.
The portfolio manager's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the individual portfolio manager and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the portfolio manager and may differ from those of other GAMCO officers, portfolio managers, other employees, or of the firm as a whole. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. An investment in any money market fund is not insured or guaranteed by the U.S. government, the Federal Deposit Insurance Corporation, or any government agency. Although the fund seeks to maintain the value of an investment at $1 per share, it is possible to lose money by investing in the fund. The fund sponsor has no legal obligation to provide financial support to the fund, and you should not expect that the sponsor will provide financial support to the fund at any time. The Gabelli Mutual Funds are distributed by G. Distributors, LLC, a registered broker-dealer and member of FINRA.